A wealth secret from Australia's most trusted financial advisor. So I'm on a mission to educate people about debt recycling. And I want to start by sharing a little bit of my own story. Uh, so debt recycling was quite common in the late 90s and throughout the 2000s. And I worked with my own financial planner uh, just after the dot-com bubble. And he shared Noel Whittaker's book, Making Money Made Simple, with me and talked to me about debt recycling. And so I actually used debt recycling way back then for myself. And I also came across Nick Halleck, a guy by the name of Nick Halleck, and Jamie McIntyre, who were talking about renting out your shares. And I'm like, what? You can rent out your shares? And I learned about that. And so I put in my own life this debt recycling strategy to work. And it was so powerful. And that's actually, so working with my financial planner, my financial advisor, I was working close with him. And that's actually the reason why I started the mortgage broking business all those years ago, was because he didn't have the finance arm. And so I started the mortgage broking business and we worked together very early on. So he would do the education around the debt recycling. I would put the finance structure in place for clients. And then we'd teach clients how to use debt recycling, exactly how I used it. But it's become a lost art form. A lot of people have forgotten about debt recycling. And so I'm actually on a mission to bring it back and to educate people about it, how it works, the strategies behind it, etc. Because I'm just seeing right across the board people's investment strategies. And I don't know if it's because we've had over 10 years of ZIRP, zero interest rate policy, whether things like housing has just gone up so much that people's investment philosophies have changed. There's a lot of YOLO and FOMO, etc. And so I want to bring back real good quality, sound money management skills. And so in this video, I want to share an extract from Noel's book. Now, everybody in Australia will know Noel Whittaker. He's regarded as Australia's most trusted financial advisor. And I want to share an extract from his book, Making Money Made Simple, chapter 21, entitled Paying It Off Faster. And he talks about his rule, his $12 a thousand rule, but he also talks about the importance of borrowing or using other people's money for investment and allow compounding. And what he describes in this chapter is exactly the power of debt recycling. And what I'll do is, once I finish sharing this extract from his book, I'll actually cut to a little 2-minute clip from Noel, who just did an interview, was it earlier this week or late last week, here in Australia. So, and just have a listen to what he says there. So, all right, let's get into this video. By the way, if you want a copy of this extract, just send me an email. You can see the email at the bottom there. I'll put the email in the description below as well. So if you want a copy of this extract, happy to email it to you. I'll also put in the description below where you can buy Noel's book. So I highly recommend buying Noel's book. So Noel's $12 a thousand rule. We used to suggest that you pay off your home loan in full before starting an investment program. But because of the way compounding works, we now recommend you pay off your loan over 10 years and no faster. If you have enough money to pay it back quicker, the surplus cash is better used to increase the number of assets that you're controlling. If you can get your head around the concept of compound interest that we discussed earlier in the book, you'll find the $12 a thousand strategy easy to understand. Because of the way compound interest works, the large earnings come in the later years of any program. Invest $1,000 a month at 10% for 5 years and you get $77,000. Increase the term to 15 years and it becomes $415,000. You can make it to 30 years, the finishing sum leaps to $2.3 million. It's the same with loans. So case study, you're 150,000 at 6.5%, which is around where interest rates are today, actually a bit lower. If you choose a 30-year term, the monthly payment will be $948, and you'll pay a total of $191,000 in interest. To cut the term back to 20 years needs just $170 a month more, in which case the interest will drop to $118,000, a saving of $73,000. Now, it's not too difficult to increase your payments by $170 a month, but if you wanted to cut the term from 30 years to 10 years, you'd need to pay $17,003 a month, an increase of $755 a month. In short, small extra payments can make a big difference when the term is long, but the effect dwindles away as the term shortens. So the $12 a thousand rule is, Noel just recommends that you make your monthly repayment $12 per $1,000 you borrow. All right, so if you borrow, say, 500,000, then that's 500 lots of thousands. So 500 times by 12 is $6,000 a month. That's the monthly repayment that you make. Once the term is down to around 10 years, extra payments don't help you much. In the example above, there is just $54,000 still to be paid once the term is down to 10 years. Paying an impossibly high $13,000 a month would cut it back to 1 year, but you would save only $49,000 in interest. Once you appreciate how small monthly amounts can be valuable in shortening a long-term loan, and that starting early makes a massive difference to an investment program, you'll understand that it is possible to have your cake and eat it too. Just reduce your home loan to a reasonably short term and then borrow for investment. So here's a case study. The Browns, age 40, owe $200,000 on their home loan and are paying it back at $2,400 a month, which will have it paid off in 10 years. They start to panic when the normal scary headlines about interest rate rises appear and decide to make paying off their home the major priority, so they'll be free of interest rate rises. They raise their payments by a massive $1,650 a month, which will have the loan paid off in 5 years. They save just $38,000 in interest. Their neighbours, the Whites, are in a similar situation, but are content to leave their loan at 10 years. They realise that there is only $88,000 of interest left to go on the loan if they leave the term at 10 years. So I'm concerned about rates going up. Using a home equity loan, so this is where we change it. We don't use home equity loan. We use the debt recycling, the master limit. It's even more powerful than this. They borrow $400,000 on an interest-only basis to invest in blue chip share trusts. The interest is tax deductible to $2,500 a month, which is less than their neighbours are paying, as it is being made from pre-tax dollars. If we assume the managed funds earn a 10% per annum income and growth combined, their value will be $4.8 million when they retire at age 65. At age 45, the Browns congratulate themselves on achieving their goal of being debt-free, but suddenly realise time is running out to save for retirement. Unfortunately, they then discover how compound interest works. Because their time frame is 20 years, not 25, they have to borrow $650,000 to end up with $4.8 million at age 65. This causes some soul searching. They can't afford the interest-only payments on a loan of $650,000 as there are no more home loan repayments to make, but $650,000 seems a huge amount to borrow for investment when all they have ever had is a modest home loan. What about the Whites? 5 years later, when they are 50, they make their last home payment and find themselves with a spare $2,400 a month. They know that they will fritter this money away if they don't invest it, so plow it into superannuation. So that's like our 401ks, Roth IRAs, self-directed IRAs, etc. in Australia, or a self-directed is like a self-managed super fund. If their superannuation fund earns 10% per annum, it will be worth almost $1 million when they're 65. Withdrawals from superannuation are tax-free to people 60 and over. So at age 65, they'll be able to withdraw $400,000 tax-free to pay off their debt, leaving themselves with an extra $600,000 in superannuation. They arrive at age 65 with their house paid off and an extra $600,000 in super and $4.8 million in quality share trusts. You can bet that the Browns will not borrow the $650,000 that will be necessary to give them a $4.8 million share portfolio at age 65. However, if they did, they would have a debt of $650,000 at 65 and would need to cash in at least $1 million of their share trust to pay off their debt after capital gains tax was taken into account. Putting compounding to work has put the Whites at least $1 million plus in front of their neighbours. And this is why debt recycling is so important. You can have one structure where you can pay down your loan, your non-tax deductible debt, your home loan. Because in Australia, unlike the US, your mortgage, your home loan is not tax deductible. And at the same time, then pull that out in an extra split to then go and invest. And look, if you guys don't understand how the debt recycling and the master limit works, I'll put a link in the description below to my last two videos. I explained it there. I did an interview with Leighton where I explained the strategy in more detail. And I did another video before that that actually lays it out with some diagrams and a little kind of cartoon graphic there. So this works great, as I said in the last video, with an income strategy. You guys know that I have a whole bunch of coal stocks. Well, my insiders would know that anyway, that are paying huge dividends based on my buy price, huge dividends. In fact, I've received my initial capital back in the form of dividends on my coal stocks. But even if you were to buy some of these stocks today, you can still get a double-digit fully franked dividend. That's a fully franked dividend. I just bought, just this week, a small cap stock that is paying a 10.5% fully franked dividend. Revenue growth of 32.5%, only paying out 60% of their earnings in dividends. And I actually think as moving forward, as times get tough, this particular business will actually do well and actually continue that earnings growth there. So, yeah, and there's other investments as well, you know, using covered calls. And even if you don't know how to do covered calls, so that's renting out your shares, there's funds both on the ASX and also in the US that you can use where they will trade covered calls. They'll sell naked puts, etc. And they'll give you a yield of 8, 9, 10%. And so then you've got that arbitrage. So if you're borrowing at 6%, you're getting paid 9, 10%, and even better if it's fully franked, then you're making that arbitrage. Allow compounding to work and you'll do well. However, with the debt recycling strategy, you can use those funds to buy a private business. In fact, in my last video, someone actually commented and shared how they use debt recycling to actually buy a business which is cash flowing at such a high rate of return. It's not funny. So for those people who are self-employed that do have that entrepreneurial spirit, that's actually probably the best way to go than actually buying shares or buying property or anything else. That's probably the best way to go. But not everybody has that. A lot of people are either doctors or accountants or solicitors or, you know, professionals, and they work in a PAYG job. And so buying a business might not be the strategy for them. But there's a lot of income type strategies here. I've also got some bank bonds that are paying over 7%. I've got funds in a 12-month fund here in Australia that's paying 10.48% as well. And that's just for me to park my cash. I don't even look at that as an investment. That's just parking my cash, waiting to actually buy some investments. So anyway, with that, what I want to do now is just cut to this clip, 2-minute clip with the man himself, Mr. Noel Whittaker.
Hey Noel, let's do a hypothetical. Someone comes to you, got 100 grand to spend, and you say to them, put the 100,000 into the index fund you just spoke of before, or leverage that and buy an investment property, buy a $500,000 property. The index funds are getting a higher percentage, but clearly because of leverage, we can control a larger asset. Which do you advise and why?
Would depend on the situation. If you're young, use the money for your first home.
Mm-hmm.
Number one.
Mm-hmm.
Secondly, I know you guys are property guys, But I would always prefer shares over residential property, always. And I'd never buy non-res property. I think non-res is too high risk for most people. I know it's good for people who can work it, but it's too difficult. Too difficult. If you're 50 plus, certainly super. If you're 30 and you've got your house paid off, borrow against your house for shares. See, shares are fine if you don't get caught with a margin call. The index has done 9% for 120 years and can't go broke. But you've got to have the attitude there will be ups and downs. In 10 years, there's 4 bad years and 6 good years. You've got to understand there'll be bad years in shares. It's staying there.
Well, Noel, according to Market Index, the Australian share market since 1900, so going from 1900 to 2017, the Australian share market has actually returned an average of 13.21% per annum. And in that time, 81% of those years, the market went up. And only 19% of those years, the market went down. And over the last 100 years, really you had 1930, 1 year, down 28%. But then the next 2 years, look how much that bounced back. Actually, over the next decade, look how much that bounced back. You had 1973, 74, the market down 50%. That was tough. That was hard. The early 80s recession, 81, 82, you can see the market there down, over 26%. 1990, 17.5%. That's a nasty year. And then 2008, and that's it. So you got 1 year, 1930, but then if you were out of the market, most people would not have jumped back in at the bottom of that market, and so they would have missed out on all those gains in the coming years. 73, 74, 81, 82, 1990, 2008. Really, they were the tough years for the Australian share market. Outside of that, just stick in there, dollar cost average, and allow compounding. And if you've got an income strategy using that arbitrage between your mortgage rate and the actual yield that you're getting on that investment, making that arbitrage. And, Noel makes a good point. The key with borrowing for shares is not having a margin line, not getting those margin calls. But if you have a look at how often the market actually pulls back significantly, this is indexing. Okay, so I get what Noel's saying. I'm an investor. I like to value individual stocks, but in index investing, you can see that the majority of the time, 81% of the time, over the last 100 years, the market goes up. So the odds of getting a margin call, even with a margin loan, is relatively low. However, using a master limit and debt recycling strategy, you don't get no margin call. Even if you're investing in 1973, 74, you don't get that margin call. Even if you're investing in 1930, you don't get that margin call. Even if you're investing in 81, 82, 1990, 2008, you're not getting that margin call. In fact, at that time, you can dollar cost average as you pour more money into your mortgage, wash it through there, pull it back out on the investment side. You can buy more assets, or in this case, the index. In 2020, we really backed up. March 2020, we really backed up the truck and loaded up as hard as we could, predominantly on commodity stocks, as you guys know. And that worked really, really well for us. We just wish we had more capital to play with at that time. So, but most people can't do that. When the market is crashing, panic and fear sets in. Obviously, Warren Buffett talks about patience being a key ingredient to successful investing, but also, it's well known, easier said than done, but be fearful when others are greedy and be greedy when others are fearful. You really got to take the emotion out of investing, and that takes time. That comes with time and experience. So, there you go. So, Noel Whittaker talks about using your home, a debt recycling type strategy to invest in the share market. Here's an example, index. He said 9%. Well, actually, here's the actual numbers. It's 13.2% from 1900 to 2017. And we've seen what the market has done since then as well. So if you guys do want to have a meeting with either myself or one of our brokers about the master limit and debt recycling and how it might work for you, obviously this is for our Australian viewers, then reach out to us. I'll put the email address, best contact email address, in the description below, and it's up here on the screen now. So feel free to send us an email if you would like myself or one of our brokers to reach out and contact you. We'll give you a few more resources as well. Anyway, if you like this video, do us a favor, hit that like button. Love to see your thoughts and opinions in the comments below. Take care, everyone, and I'll see you all again on another episode of Finance Uncut. And just a reminder, the information provided in this video is for education and entertainment purposes only. Nothing on this channel constitutes as financial advice. The information in this presentation is no substitute for financial advice, and all investors should seek advice from a licensed financial advisor having regard to your own objectives, financial situation, and needs.